Hello, everyone. I hope you guys are doing well. So, welcome to the first session of the revision classes as far as for the tax UK is concerned. I am your instructor, and I'll be taking you along this journey of the crash course discussion related to preparing ourselves as far as for the exam is concerned. So, I'll be starting without wasting any time and a few things before we start. Basically, I have planned this session while keeping in mind as far as the latest examiner reports are concerned, because I was just going through them and the common mistakes which the examiner tried to highlight that the most candidates do. I'll be keeping those in mind, and then I will be taking you along the multiple questions that where the mistakes are basically been happening, or how the candidates while being into the exam pressure they tend to do the mistakes. So I'll be highlighting those as well. I'll be guiding you how to avoid those mistakes and then how to secure as far as your marks are concerned. So let's start without wasting any time. And over here today, the first question we have today, basically, this is the HANA, and this is going to be from your the Kaplan exam kit over here. Now, whenever you are gonna go into the section C type question, obviously you will see the start of the question where it states that the scenario relates to the three requirements. Now, as soon as you read this, straight away just scroll down. Look over here, you have the self-employment over here. Then you have the employment over here, you have the living accommodation, beneficial loan, travel and expenses, right? And then after that, you have the multiple requirements over here. And the first requirement is where you have to calculate the trading income assessment of HANA for the tax year 25-26 over here, right? So you have to calculate the trading income assessment of the HANA for the tax year 25-26. Now, if I go over here, I'll be sort of guiding you from the paper point of view. You just simply go over here, you just write the part A, the requirement, and that is going to be the trading income assessment for the tax year 2025-26 over here. Done? Okay. Now, if I go, we have a trading profit for the year ended 31st March 2026. Now, if I go down, I have to see my trading profit. So self-assessment or the self-employment is the one we are going to have over here. So this is Hannah's tax adjusted trading profit for the year ended 31st March 2026 was 81,770 over here. And this figure is before taking into account the capital allowances. So capital allowances are not been taken into account. And the HANA uses the accrual basis for the capital allowances, right? And then we have the information related to the capital allowances over here, where we have the tax return on value for the plant and machinery for the main pool, and the car is over here. Then we have the information related to the car over here as well. And then we have the office equipment over here as well, right? Okay, now if I go, I have my profit of 81,770 over here. So from this, I will less my capital allowance. Obviously, I have to deduct the capital allowances from here. And for that, I have to go to the working one over here. So I'll go into my workings, and my working one is going to be related to as far as the capital allowances are concerned, right? And then I have the main pool, and then I have the car over here with the private use as well. So over here, I will simply have my AIA, my main pool, then I have the private, use car, and then I have my allowances over here as well. Okay. Now, I have tax written down value brought forward. On the main pool, this is 25,000, and then I have a car which has the value of 7,700 as well. After that, it says the car has a CO2 emission of 105 grams per kilometer and is used by the HANA 40% and is used by the HANA 40% for the business mileage over here. Okay. So basically the 40% is for the business, 60% is basically going to be by the HANA over here. Okay. And then we have the next point on 15th May 2025. HANA bought office equipment for 4,500. Then on 17th August, she replaced her old car, which she had purchased for 11,200, by exchanging it for a new one with a part exchange allowance of 10,000. HANA had to pay additional 25,000 for the new car. The CO2 rate of the new car was 45 grams per kilometer, and the private usage remained the same over here. Okay, so what happened now? We got this new equipment over here for 45. So I'll go over here. I will write the office equipment over here. Addition office equipment, that is for 4,500. So I'll have the AIA of 4,500, which will go over here. And then we have the disposal of old car. And in this, we got the part exchange allowance of 10,000 over here. So I'll minus the 10,000. And then we will have the balancing charge over here on this car, which is going to be 2,300, which I will take, and I will minus from here. And with that, basically before minusing, I have to see that for the business point of view, that is the 40%. So I'll have the 40% over here. So 2,300 into 40%, I'll get the 920, the balancing charge over here. After that, I got a new car over here. The old car had a balancing, like, the part change balance of the 10,000. Additional amount paid was 25,000. So basically the value of the new car over here, this was basically, I can have it private use, new car over here, right? And then I can have this balancing charge over here. And as far as the new car is concerned, I can write down new car bought, and that is going to be for the 35,000, because 25,000 over here, 10,000 over here. So that's going to be at 35,000. And then with the new car, I am going to have the written down value at 18%, because this is again going to be with the 40% usage over here as well. And so this is going to be over here, and this is going to be 3,500 into 40% into 18% over here, right? So we'll have this one over here as well. So this is the sorry, this is 35,000 basically is the value of the car over here, right? So we'll have this as the allowance over here. Okay. And as far as this car is concerned, obviously we will be deducting the whole of the amount from here. And this is going to be 35,000 into 18%. So that 6,300 is going to be deducted from here. Right. And then afterwards, we have some other information as well. On 31st December, she sold some old plant and equipment for 24,500 over here. Okay, so disposal of old plant, that was for 24,500. So this has been disposed of. So I have a balance of 500 over here. So this is simply going to be a small pool written down value because the value is just the 500. So I'll give the 500 balance over here as well. So over here, the tax written down value carry forward, that is going to be only on this area, which is going to be this and this over here. So that is something like, we have to do the sum of this and this value. So that's going to be only 28,700. As far as over here, these are going to be the zeros over here, right? And then the total allowances will have them at 6,600. So the total allowances which are going to be available to us are basically 6,600. So I'll minus the 6,600 from here, right? So when once I do, I get my tax adjusted trading profit for the year ended 31st March 2026 over here, which is going to be 75,170. And then afterward, I read about this line, the transition profit, they were 4,500. So I will simply have this transition profit of 4,500, which will I add. So I'll have my trading income, overall speaking, for 25-26, which is going to be 79,670 over here. So this is going to be 79,670 over here that I'm gonna have over here, right? Okay. Now, if I move around from here more, the second requirement is calculate the employment income of Hannah for the tax year 25-26, and you should indicate by the use of zero for any item which are not taxable or deductible over here. Okay. So now I'm going to go in my part B. I'm going to do it over here. And this is going to be the employment income for the tax year 25-26 over here. So I have my employment over here. So on 1st January, Hannah commenced the part-time employment with the Lumley Limited, earning a gross salary of 125,000. Lumley Limited also provide the Hannah with the following benefits over here. Year end is 31st March. You got the employment on 1st January. So January, February, March. It's been 3 months, right? So the salary over here is going to be time apportioned for 3 months over here. So that's going to be 31,250 over here. And then she got the living accommodation over here. And living accommodation, we have Anna moved into a property owned by the Lumley Limited, which does not qualify as a job related accommodation. Okay, so this is a property which is, or the accommodation given by the employer on this on the site, and the property has an annual value of 16,000, and the property was purchased by the Lumley Limited, overall speaking, on 1st September 2023. Okay, 3 years ago, technically around about 3.5 years ago. Okay, for 250,000, and its market value on 1st January 2026 was 280,000 over here. Okay, so we have this annual value of 16,000 over here. Okay, so we have this annual value over here. So we can simply have it over here. So I'm going to give the reference to the working two over here because this is the working one which we had. So I'm just going to go down workings, working 2, living accommodation over here. And if I go into my living accommodation, I can have it over here like this. Annual value. And the annual value of the accommodation over here is 16,000. And then with that, I am going to look over here now. And the property was purchased for 250,000. So basically, this is going to be an expensive accommodation over here, because if I talk about as far as the rules for the property is concerned, this is going to be uh the timeline. If I try to convey to you over here, number one, this is more than 75,000, right? This is an expensive accommodation. Secondly, it was purchased in 2023. So this is less than the 6 years, nah? This is the less than the 6 years when Hana basically moved into over here, right? So over here, this is an expensive accommodation. So we need to have the additional charge for the property over here. And the additional charge is going to be like this. We will add up additional charge. And this is going to be 250,000 minus 75,000, the threshold, multiplied by 3.75%, the interest rate that we have over here. So this is going to be 250 minus 75,000 into 0.0375. So we get 6563 over here, right? So if we get 6563, so this is going to be a total of 22,563, and our taxable benefit is going to be for 3 months over here, and that'll be this into 3 by 12. That is going to be 5641 over here. So 5641 is going to be our living accommodation. Done. Then we got this beneficial loan over here. Now, obviously, for the beneficial loan, we'll go for the working 3 over here. And if I talk about the beneficial loan, Lomla Limited provided Hannah with an interest-free loan of 60,000 on the 1st January 2026. She has repaid 2,500 at the end of each month, starting on 31st January. So she paid on the 31st January, then obviously the 28th Feb, and then she paid on the 31st March as well. And the taxable benefit in respect of this loan is calculated using the average method over here. So basically, we have to calculate the average method over here in order to calculate the what do we call it as the benefit, basically related to as far as the beneficial loan is concerned. So if I go down now into the working 3, the beneficial loan, let's see what do we have. And basically, we have to use the average method over here. So balance at 1st January 2026. We have the balance of 60,000 over here. And then we have the balance on 5th April 2026. That is going to be 60,000 minus, I have repaid 2,500 into 3. So that's going to be minus 2,500 into 3. So that is 52,500 over here. So if I go, this will become a total of 112,500. So my average loan is going to be 112,500 divided by 2. So that's going to be 56,250. So my taxable benefit 56,250 multiplied by 3.75%, my common interest rate that multiplied by 3 by 12. So I get 56,250 into 0.0375 multiplied by 3 by 12. I get 527 over here. So 527 is going to be my beneficial loan over here. After that, I have the travel and expenses over here. And this says during the period 1st July to 5th April, Hana used her private car to travel 6,000 business miles. She was reimbursed by Lumley Limited at a rate of 50 pence per mile. And then Hana also, paid 450 of her own bank account for the hotel rooms, which she stayed in the business trips. Lumley Limited only reimbursed her for these expenses on 20th March, basically. So Lumley did happen to reimburse her for these expenses. So if it's been totally reimbursed, it's fine. We don't take anything over here. So this is something I'll call it as the reimbursed expenses. Reimbursed expenses. So they will be zero over here. Okay, I have to write the zero like this and make it the general because it has asked me specifically to mention where there is no benefit or something. I have to mention it with the zero. And then as far as for the beneficial loan is done, now the traveling expenses. Okay, so as far as the mileage allowance is concerned, so mileage allowance is gonna be the working for. I'll go over here working for, and that's gonna be the mileage allowance over here. Now, if I go into the mileage allowance, this is simple that, normally the mileage allowance allowed is the 50 pence. I'm sorry, the allowed received is the 50 pence, allowed is the 45 pence. Nah? So I'll just take up the difference that what's the additional over here. So mileage allowance received is 6,000 miles multiplied by 50 pence. So that's 3,000 less approved mileage allowance over here. That's 6,000 into 45 pence over here. So I'm going to minus the approved ones. That's 2,700. So the taxable benefit is 300. So for this, if I go up the mileage allowance, I'll put up 300 over here. So long story card short, my employment income 37,718 over here, right? A straightforward one. Done. Okay. And then explain how the tax treatment of the property involved or the property provided to Hana would differ if it qualified as a job related accommodation. Now, as far as for the part C is concerned, that's going to be a simple, straightforward answer, and that is if the property provided to Hana by Lumley Limited qualified as job related accommodation, then there would have been no taxable benefit. That's it. It's a 1 mark question. So the explanation should be only 1 mark related, right? No need to write or take along, like, as far as the big essays are concerned, it's not required. A straightforward, simple answer is the best one to have over here, right? So now let's just move on to as far as the second question is concerned, and let's see what does it has to offer and how to do it. Okay, so this is the foodie question that basically that we have, and this is a section B type question from the Kaplan exam kit. So let's see the question. On 31st December 2025, Foodie resigned as an employee of the Gastronomic Food PLC. And on 1st January 2026, Foodie started self employment running her own restaurant, preparing accounts to 30th September. The following information is available for the tax year 25-26 over here. For the sake of the employment, basically, this one, during the period 6th April 2025 to 31st December 2025, Foodie earned a salary of £38,000 and was provided with the following benefits over here: the company car, and then he paid the customer field PSC paid the £6 per night to cover the incidental expenses when she was working away in the UK for 14 nights, and then the company contributed 6% to the gross salary of 38,000 into the Gastronomic Food PLC occupational pension scheme as well. So this point is basically related to the employment. So I'll straight away go down and over here I have the question number one. Which two of the following statement concerning the taxable benefits in respect of the company car for the tax year 25-26 are correct over here? In respect of the company car. So the company car is gonna come over here, this point. A car with a CO2 emission of 132 grams per kilometer and a list price of 19,000, who was also provided with all the diesel fuel for the car as well, and the car does not meet the RDE2 standard over here. Okay. Now, overall speaking, the CO2 emission, that is 132 grams, so I'll round it off to 130 grams for the sake of calculations over here, right? And the car has been available for from 6th April to 31st December. So April, May, June, July, August, September, October, November, December. 9 months. It has been available for 9 months over here. So as far as for the diesel car is concerned, we are going to have the workings, and let me share this tax table. Let me just open it up. I forgot to open it earlier. Okay, let me take the screenshot. Now, if I scroll down, so this is what we have overall speaking. Okay, I'm going to paste it here. This tax table is something which is available to you. So this is basically from 51 to 54 grams per kilometer. This is 16%. And over here, this is 130 grams over here, right? So the basic threshold is basically 55 grams. So this is not the RDE2 standard. So I'm going to have for the diesel car, the percentage over here, this will be, look, this is above 55 now. So this is 17% plus the 4% extra for not meeting the RDE2 standard. So this is going to be 17 plus 3 is 20, 21% over here. And then this is going to be 130 minus 55 by 5, right? And then this is going to be divided by 5 over here. So I get 15 over here. So my total percentage, it goes down to as far as the 36% is concerned, right? So my appropriate percentage is going to be the 36%. So the car benefit, if I look, this is the 19,000. So 19,000 into 36% into 9 by 12 is what we are going to have over here. So that's going to be 5130 over here. And then along with the car benefit, we have the fuel benefit as well. And that is going to be, if I go for the fuel, okay, I haven't copied it up over here. There it is. The car fuel benefit, 28,200. So that's going to be 28,200 into 36% into 9 by 12. So that's going to be 7614 over here as well. So this is what we have for overall speaking as far as the car is concerned. So I'm going to paste it down. So this is going to be we'll have a car benefit of 5130. This is going to be the B over here. And then the fuel benefit, this is 7614, so fuel benefit of 7614. So that's going to be the option E over here. Then the question number 2 asks, how much is the total taxable benefit for the payment of the overnight expenses and the pension contribution by the company for the tax year 25-26 over here, right? Which we can have. Okay. So for 25-26, what is the total taxable benefit that we can bring in over here as far as for the overnight expenses and as far as for the employer pension is concerned? Okay. Now, if you remember from your regular classes and all, the maximum amount of the reimbursement that we can have for the overnight stays, that is basically at £5 per night, right? So if the employer reimburses you at £5 per night, that's fine. It's acceptable. But if the employer reimburses more than that, then the whole amount, it becomes taxable over here, right? So if the amount would have been less than equal to the £5 per night, then it would have been acceptable. But if the amount exceeds from £5 per night, then the whole amount, it becomes the taxable over here. So Footy basically spent 14 nights. So this is going to be the one which is going to be, taxable over here. So I can write overnight expenses paid taxable 14 nights into this is gonna be what, 6 over here. So 14 into 6, that's gonna be 84 over here. And then afterwards we have the fuel benefit, and the fuel benefit over here, this is the fuel benefit, right? Dashboard. So no, sorry, the pension contribution, my bad. This was the pension contribution. So the pension contribution, and the company contributed 6% of the pension contribution, so it's okay. The pension contributions made by an employer, they are exempt from as far as the taxable benefits are concerned. So the total amount is going to be the 84 over here, right? So amount over here is just 84 over here. So we'll go for the option B over here. Okay, and then what is whose tax suggested trading profit before the capital allowances for the 9 months period ending 30th September 2026, assuming she elects to use the accrual basis over here. So if I go into the accrual basis for the self-employment, I have my net profit of 134,354, and then I have these 3 points that I can, work around over here. So my net profit 134,354, and then legal fee includes conveyancing fee of 1,400 for the purchase of the restaurant over here. Now, as far as this legal fee is concerned, in this 1,400 for as far as conveyancing is concerned, this fees, if I talk about, this is going to be something which is going to be allowable over here, and this is something we are not going to, minus it up as far as from our net profits is concerned. So we can write this legal fee and we'll add it back. This 1400 over here, this will not be deducted as far as the profits is concerned, because this is something which can be capitalized over here, so it's not supposed to be deducted from as far as the the net profit is concerned. And then after that, Fu purchased a 10-year-old restaurant on 1st January. She lives in a flat that is situated right above the restaurant, and 1/4 of the total property expenses of 12,800 relate to this flat over here. So this is the private accommodation kind of sort of thing. And this is something we will have over here. The 12,800 into 1/4, so 1/4 is what we are gonna have over here. So this 3,200 is gonna be added up over here as well. So my trading profit before capital allowances, it'll become a 138,954 over here. So this 138,954 is what I am going to have over here as my capital allowances over here. Well, I hope it's clear to you guys. Now, moving ahead from here, if we talk about the next question in line, who has not previously been required to submit a tax return to the HMRC? So, no, sorry, not the fifth one, fourth one. What is the maximum capital allowances claim that Fu can make in respect of the 9 months period over here? Okay, for the period ended 30th September 2026 over here. So on 30th September 2026, Fu purchased a car, 40 grams per kilometers over here, and the private use is basically 30% to 70% is the business. On that, we can claim as far as the capital allowance is concerned. So the capital allowances for the private use car is over here. Then we have the allowances over here. So the addition for the car, 14,600 and an allowance, 18% into 9/12 as well. So that's going to be this into 18% into time portion 9/12. And this is something which is going to be 30% is for the private use. So I'm going to have the 70% which is allowed. So it's going to be 1971 into 70%. So that's going to be 1380. So capital allowance which is allowed 1380 is what we are going to have over here, option A. Right? Okay. Now, Fu has not been previously required to submit a tax return. Now, by what date Fu must inform the HMRC of her new source of employment income? And what is the filing date for the first tax return that includes the income from the self-employment over here? Now, over here, if you want to answer this question, basically, you just have to see the number of dates over here. When is the date when Fu started her own business over here? Fu started her own business. Okay. Fu started self-employment on 1st January 2026. So technically, she started on 1st January 2026 over here, right? So she started her business on 1st January 2026. And technically speaking, this is going to be in the tax year 25-26. So during the year, this basically tax year, Fu will be taxed on the profit arising from the period to 1st January to 5th April over here, right? So the time limit for notifying the HMRC is 6 months from the end of the tax year in which the liability arises. So technically speaking, your ending is 5th April 2026. So count the 6 months after. That is going to be after the this is going to be for the April, May, June, July, August, September. So technically it's going to be the October over here, right? So the notification period or the date is going to be the 5th October over here. And as far as the filing is concerned, that is going to be the 31st January following the end of the tax year that we have. So technically speaking, for the 25-26, this is going to be the 31st January on 2027 over here. So if I talk about the informing, this is going to be done 6 months. So this is going to be done on the 5th October, right? So this 5th October is going to come in over here. And the tax return, which I have to file, is going to be on the 31st January over here, right? So technically answer B is the correct one, because over here we have to choose this one, and over here we have to choose this one. So the correct answer is going to be the option B. So this is what we have overall speaking for this question over here. Now let's move to the next question. Okay, the next question over here is 109 Ethyl Company. And if you look over here, the scenario relates to two requirements over here. Okay. Ethel Brown started to run a small bed and breakfast business as a sole trader on 6th April 2025. She prepared her first accounts for the year to 5th April 2026. She has read about the cash basis for the accounting and HMRC flat rate expense adjustments, which are intended to simplify the tax accounting for the small businesses. So in the year to 5th April 2026, he has the following transactions: 1, 2, 3, 4. Now, the best part is the requirement is calculate Ethel's taxable trading profits for the year ended 5th April 2026, assuming that she prepared her accounts using the cash basis and opts to use the HMRC flat rate expense adjustment for both the car and the private use of the business premises as well. Your answer should be supported with brief notes to explain how you have treated the transactions 1 to 4 above over here. Okay. Now, I'll go over here as far as the start is concerned. And this is going to be the part A over here, where we have the Ethel Brown and we have the calculation of taxable trading profits, assuming the cash basis. So we are using the cash basis over here is what we have over here. Okay, now, if we look, we have first thing over here, Ethel earned income of 74,500 at 5th April. 10,000 of the income was still outstanding. So technically her revenue 74,500 minus 10,000 over here. So this is gonna be what? 64,500 over here. I'm going to give the reference of note 1 over here for this point, because if I go into the note 1 over here, this is going to be the income of 10,000 outstanding at the year end is excluded from the revenue figure when calculating the profit using the cash basis, as this 10,000 is not received yet, so it becomes the accrued income, right? And under the cash basis, only the income earned in cash is included in the revenue, right? Second part, apart from this, okay, now Payments of 25,000 in respect of the food, utilities, and other household costs. Okay. So we will less the food, utilities, etc. So that's gonna be what? We have 25,000 over here. Okay. Now, she lives in part of the bed and breakfast premises with her husband and two children. 35% of the food, utilities, and the other household costs relate to their private use. The HMRC flat private use adjustment for the four occupants of the business is 7,800. Okay, so basically we have this flat rate adjustment over here, which is gonna be the reduction allowed by the HMRC is 7,800. So I'll minus this 7,800 from here, and the net amount that we are going to deduct in the name of the expenses is going to be 17,200 over here. And with this, I will give a reference of the note 2. And under the note 2, I will simply say that the total payment of this 25,000 can be deducted from the trading profit, but the flat rate private usage adjustment of 7,800 must be added to the trading profit, for tax purposes, because they say simply the amount which is allowed is going to be the 7,800. So I've adjusted this amount over here, right? Then second part, paid a car dealer 14,000 by check for a car with a CO2 emission of 40 grams per kilometer. She also made payments totaling 3,000 related to the running cost of the car for the year. She has used 40% of the time for the private purposes, and she drove 11,000 miles over here as far as for the business is concerned. Okay, now if I go into as far as the mileage is concerned, basically I have to take up the mileage allowance over here, right? So I can take up the sum later, right? So let's just not underline this up. And now I have this mileage less mileage allowance, and that's going to come in the note 3 over here. So I'll go for the note 3, right? Now, as far as the mileage allowance is concerned, she paid 14,000 for the car, 3,000, right? As far as for the running cost. So the cash payment in respect of the purchase of the car and running cost of the car of 14,000 plus 3,000, totaling 17,000 are not allowed, right? These are not allowed over here from the, these are not allowed and will not be considered as deductible expenses, right? Rather, the approved mileage allowance will be calculated over here for the sake of the allowance calculation over here, right? So the approved mileage allowance is 11,000. So for the first 10,000 miles, we have 45 pence over here. And then For the next 1000 miles, we have 25 pence, right? So the total is 4750 over here. So this 4750, I'll be deducting it over here, right? And then I have on 1st March 2026, she acquired an item of kitchen equipment for 350 on credit terms. She paid the supplier's invoice on 15th April over here. Okay, so basically she paid for the equipment over here now. So less the equipment purchased. So we won't have anything because basically on the equipment we can claim the capital allowance. Let me go into the note 4 and explain over here. So note 4, we have a tax deduction can be claimed from the trading profits for the full cost of the kitchen equipment, right? When the invoice is paid, right? So over here, we can claim the whole tax deduction amount over here when the invoice is eventually going to be paid. So my taxable trading profit over here in this case is going to be 42,550 over here, right? So this is what we have over here. Now, if I go into the part B, it says calculate the Ethel's tax suggested trading profit for the year ended 5th April 2026, assuming that she elects to prepare her accounts using the accrual basis over here. Okay, if she goes Ethel Brown calculation of tax adjusted profits using the accrual basis. So we have the revenue now. And if you remember, we had the revenue of 74,500 over here. Right? So we have 74,500 over here as far as the revenue is concerned. After the revenue, we will less this food utilities over here. So food utilities, they were for 25,000 and 35 is personal into 65% is what we are going to have over here. So we have this 16,250, right? So we'll have this amount as 58,250 less car running cost. We have an actual cost of the running cost, not the purchasing. On the purchasing, we'll have the capital allowance, but the running cost, we have this 3,000 over here. 40% is our, 60% is for the business. So this is going to be 60% over here. So that is what? 1,800, I guess. So this is the 1,800 over here. Okay. Then we have the equipment will get as far as the capital allowance is concerned. And over here, we have the capital allowances, which I'm going to go into the workings. And as far as the capital allowances are concerned, I have nothing over here. This is going to be the main pool. This is the private use. And then I have the allowances. So we have the additions over here. We got the car. Put 14,000 over here. We got the car over here. Right? And this is the 14,000 for the car. After that, we got the equipment over here. And the equipment was equipment 350 over here. So less AIA 350. So 350 is going to be over here as well. Right? And for the private use car, we'll have the WDA at 18%. So this into 18%. And then again, we have 40% for the private. So 60% is going to be over here. So 2520 into 60% is going to be 1512. So the total allowance for the car and the equipment is going to be 1862 over here. Right? So I'll have my 1862 as far as for the capital allowance is concerned. And then that's going to be the sum of these two. I'll minus these. So my tax suggested trading profits over here are 54,588. Right. So this is how side by side we do the comparison over here. Right. I hope it's clear. Okay. Now time to move forward. The gross amount over here is 8,600. Let me show you over here. See? Yeah, this is over here. No, the gifted scheme is over here. So if we would have had this amount over here as well, so this would have reduced more. So this is the 50% over here now. So 8600 into 50%. Let's do this directly over here. So that's 4,300. Yes, true, true, true. It would have like personal allowance would have increased by 4,300. So this is true as well, right? Because our income would have dropped, so obviously our personal allowance would have increased by this amount as well. Okay, now moving ahead from here, we have now our, after these, we are now having this 102 over here. Next question. Uh-oh. Okay. Okay, now we have this second question over here. This scenario relates to 4 requirements. You should assume that today's date is 4th April 2025 over here. Now, on 2nd April, Kagan inherited some quoted ordinary shares valued at 510,000 following the death of his aunt. Kagan is unsure whether to retain the shares or sell some of them in order to make some alternative investments over here, right? So this is something still to be thought about, that what to do or not to do. Number one. Then Kagan is 61 and is an additional taxpayer, additional rate taxpayer. So prior to the inheritance, his taxable income consisting entirely of employment income for the tax year 25-26 would have been 400,000, right? So the income tax liability on this income for the tax year would have been 166,203 as well. Okay. Then prior to receiving the inheritance, Kagan's chargeable estate for inheritance tax purpose was valued at 1.7 million, and then the inheritance tax of 550,000 would have been payable or would be payable were her to die in the near future. Okay. Now, retain the inherited shares. One thing he's thinking about, sorry, to sell, and then one option is to retain the inherited shares. Now, if Kagan simply retains the inherited shares, then he will receive dividend income of 15,300 during the tax year 25-26. This is addition to his employment income of 400,000. Now, after reading all of this one scenario, this is one scenario. After reading all of this scenario, stop right here and go to the question one. Right? Now, the question one is the part A. Calculate Kagan's revised income tax liability for the tax year 25-26 if he retains the inherited shares, right? So if the shares are being retained, then what is going to happen over here? Okay, I'm going to go up. Part A, I will reset it. I mean, as far as posting or arranging the answers concerned, but for now, just focus on to the calculations. The part A is the shares are retained. Additional income is dividend income of 15,300 over here, right? So additional tax will be on dividend income, right? So the dividend income is 15,300 less the threshold available, which is minus 500, irrespective of the income level. The first 500 is not taxed. So the taxable amount is this 14,800. And now, if you remember, the higher tax rate is higher tax rate is this is 39.35% over there, right? So yes, Ms. Vanessa, that is 39.35%. So the additional tax is 14,800 into this 39.35. So that's going to be 5824 over here, right? So that's going to be 5824. Now, the question is asking revised income tax liability. Total current tax liability, that is, I did happen to see, the income tax liability for the income would have been 166,203, 166,203, and additional tax 5824. So total revised tax liability 172 027 over here, right? So this is the part A that we solved. So I'm just going to go and paste it here. Now, part B and 1. Explain why little or no capital gain tax will be payable if Kagan sells some of his inherited shares. Now, if I go over here, sell of the shares, let's read about this and then we'll have a true picture over here. Kagan is considering selling some of his inherited shares for which there has only been a minimal increase in value since he inherited them to fund the following four investments, of all of which will be made at the start of the tax year 25-26 over here. Okay, so second in April, basically Kagan inherited some shares quoted at 510,000 over here, na? Right? So I have to see at what amount are they being sold over here. We have gross pension contribution 100 over here. Annual, withdraw 25,000 over here. 50,000 premium bond, property. Let's just in 9,000 and okay, we have not been provided. We have not been provided over here with the value. If Kagan sells some of his inherited shares, and we have just been provided the information over here, Kagan is considering selling some of his intended shares for which there has only been a minimal increase in value since he inherited them, right? So, this is B with 1 over here. I can simply say that the minimal increase since the inheritance of shares will not cover any additional tax, as this minimal increase will be covered by annual exempt amount of 3,000 over here. Basically, we have the annual exempt amount of the 3,000 over here, because in order to tell that why little or no capital gain tax is going to be payable, right, over here, that's going to be in that situation where the increase is not more than 1,000. We have not, sorry, 3,000. We have not been provided with what is the increase over here. Otherwise, we would have gone with the pinpoint accuracy over here. So I'm just assuming that minimal increase that's going to be covered up with this 3,000 over here. Right? So I'm going to go over here. I'm going to paste it here as a part B. Then, second number. Calculate Kagan's revised income tax liability for the tax year 25-26 if he sells some of his inherited shares and makes the four alternative investments. Okay, so he's selling some shares and then he's making all the four alternative investments as well. Okay. And notice that for this part of the question, you are expected to produce a full income tax computation. Okay, because we have to calculate the whole liability. And you should indicate by the use of the zeros for any items which are not taxable over here. Okay. So let's start with this part over here. I'm gonna go. This is B's to Kagan, right? Kagan's revised income tax liability. Yep. Revised income tax liability for 25-26 over here. So we have the employment income. Consisting of the employment income would have been 400,000, right? Over here. Then we have number one, Kagal will make a gross pension contribution of 100,000. Kagan is a member of a pension scheme, but has not made any contributions in the recent year because his income has been substantially lower than it is for the tax year 25-26. He therefore has sufficient unused and annual allowances to cover a pension contribution of 100,000. Kagan will immediately withdraw 25,000 of the pension fund tax free. This is the permitted tax free amount. However, no pension will be taken during the tax year 25-26 over here. So, technically speaking, if I talk about this point over here, if I talk about this point over here, this is where the personal contribution that I have, the pension contribution, this is going to be, yeah, tax free over here, no? So no issues. I will simply write pension free or the tax free lump sum amount over here. So that's going to be a 0 over here. Okay, we have to denote it with a 0 now, so I'm going to over here with a 0. Then, point number 2, Kagan will invest 50,000 in premium bonds. Okay. The expected amount of premium bond prices will be received during the tax year 25-26 is 700 over here. So basically, you will be receiving this premium bond price over here. And if I talk about as far as the premium bond prices are concerned, they are after tax. So I won't have to pay any tax over here on them as well. So premium bond price, that's going to be 0 as well. Right? So let's have some zeros over here. Then, third one, this is Kagan will invest the maximum permitted amount of 20,000 in a cash individual saving account. The individual saving account will pay interest of 400 during the tax year 25-26 over here. Now we have the interest over here, right? So technically this is the interest from the individual saving account, non-tax interest from individual saving account. So that's going to be 0 over here as well. Then we have next thing in line. Kagan will purchase a freehold property for 295,000. Okay. The property will be let out unfurnished and Kagal will receive the property income of 9,600. So we have a property income 9600. Then after the property income, we have, after making these four investments, Kandan will be left with 65,000 of the inherited shares, on which he will receive the dividend income of 450 during the tax year. He will also have his employment income of the 400,000 as well. Now we have the dividend income of 450 over here as well, right? So my total income is going to be 410, then less personal allowance 0, and then we will have the taxable income 410 over here, right? Now we are going to have the calculation of income tax liability over here. Now we have the personal pension scheme over here as well, right? And if I go, I did happen to read about the personal pension scheme over here. So we have a over personal pension contribution of 100,000 over here, right? And he therefore has sufficient unused allowance to cover the pension contribution of 100,000 over here. So with this 100,000, the basic tax bracket is going to be increased over here as well. So we have the tax with the basic tax bracket. So I have the basic tax bracket of 37,700 plus 100,000 as well, right? So my basic tax bracket is going to be increased by this amount. On this, I will have the 20% of the tax. So this is going to be 137,700 into 20% over here, right? Then my next one, which is going to be my higher tax bracket, the amount limit is basically 125, 140 over here now. So the higher is HGHER. So higher is 125, 140 plus 100,000 minus 37,700 into, I have this 40% over here. So that's going to be 225, 140 minus 37,700 into 40% over here. So I get this 74,976. And then I have, after the higher, I have the additional rate over here as well. And this additional rate, I will simply have, this is 410 now, 050 minus the dividends 450 from here, right? The dividend amount 450 is going to be deducted from here. And then I will deduct, this is 225, 140 into 45% over here. So I get 410, 050 minus 225,140 into 45%, done. And then I have my dividend income, that is 450, automatically taxed at 0 because first 500, irrespective of your income level, is taxed at 0 over here. So my income tax liability is 185,276 over here. Let's cross check if we have done everything right over here. Okay, so we had this 37,700. Okay, so we text 100, 1, 2, 3 plus 37,700 over here. Then we text this 225140 minus oh, okay, 37,700 over here. And then we text this was 410,050 minus 225140. So how much of the amount have we texted? We have text extra amount over here. 510. We have charged 100 extra over here into the name of the tax over here. Let's cross check. Let's cross check. I have charged extra amount of the tax over here. See, this is 137, this is 187, and then this is 184 over here. So, technically speaking, this is 225 plus I had an 100,000 extra over here as well. I was supposed to minus that as well. So minus 225, 225 is from here, right? This one. What about this 100,000 over here? I forgot to put in over here as well. So that will be deducted as well. So the remaining amount minus 100, 1, 2, 3. So that's gonna be 140 over here. Okay. Now let's cross check again. We have property income over here. So we have 37,700 over here, 100,000. Now the amounts are complete, right? Yes. Now it's fine. Now it's fine. So you should indicate by the 0 as well. So we are done with this. Now the part C is for each of the 4 alternative investments, pension contribution, premium bonds, ISA and freehold property, state whether the investment will reduce the Kagan's potential inheritance tax liability compared to him retaining the inheritance tax over here. Okay. Now, if I talk about this point over here now, this is something, the amount which is normally, invested in the pension funds, right? The amount which is invested into the pension funds normally outside of the Kagan's estate is going to reduce the potential inheritance tax liability, right? I mean, you if you invest the amount in the pension fund and you don't withdraw it from the as far as the your funds are concerned, so that is something which is going to reduce the potential inheritance tax liability over here. And then the investment in these premium bonds, the investments which we did over here into the premium bonds again, and then we had this the individual saving account over here as well, right? And the freehold property, they're not going to affect anyway as far as the inheritance tax liability is concerned, because one asset is replaced by another asset of the equivalent value over here, so there's no difference over here. Whatever the amount we have, we are investing it somewhere else. We are investing the same amount somewhere else. So it's not going to affect as far as, the inheritance tax is concerned. So it's not going to affect it up, right? So this is what we have over here. Done? Now let's pause for 2 or 3 minutes and then we'll start in with the question number 3 over here. Okay, now the next question in line is ESME. This scenario is related to 3 requirements. So we have the ASME is employed by HHK PLC. The following information is available for the tax year 25-26. Point number 1, 2, 3, 4, 5 with the other information. Then we have the Asma's husband as well. And then we have the requirement. Calculate Asma's income tax liability for the tax year 25-26. Note, you should indicate by the use of the zeros for any items which are not taxable or deductible. So this is the primary requirement over here to calculate the income tax liability over here. So I'm going to go over here. I'm going to write, this is the part A of the questions. Asma's income tax liability for 25-26 over here. Now, we have the salary, bonus, and other stuff as well. Okay. So I'll go with the non-saving, saving, dividend, and then the total income over here. So my start is going to be gross annual salary 45,000. So we have a gross annual salary annual salary 45,000 over here. Right? After that, point number 2, during the tax year, ASME received a bonus of 19,000 on 10th April 2025 and another bonus of 22,000 on 22nd March 2026 over here. Okay. ASME was contractually entitled to receive these bonuses on 31st March 2026 respectively. Okay. Now, this bonus was supposed to be received on 31st March 2025, and this was supposed to be received on 31st March 2026 over here. So we were entitled to this bonus on 31st March, now this 19,000. So this should have been in the previous year, tax year, and this 22,000, this is on to the 31st March 2026. This falls into the current year. So I'm going to bring in this bonus over here. So bonus 1, that's going to be 0. Bonus 2, that is 22,000. So I will bring up this bonus over here. Right? Okay. So 22,000 is going to go over here. And this is going to be 0 over here. Then during, okay. Yeah, the bonus topic is basically you just have to see the date on which it is accrued, the date on which you become the entitled, it's going to be accounted for into the income according to that, right? You just have to see the date on which you are entitled, because if you create your tax year over here, now, like say in case, look, this is my tax year, this one. Now, if it says that I have the tax liability for the 25-26 over here, this is April 26 over here. It is started on April 25th over here. This is 6th April and this is 5th April over here, right? Now, the bonus, simply see on which date you were entitled, because it's going to be taken up into your income. The first bonus that we have over here of the 19,000, you are entitled for this on 31st March. You were entitled over here on this 31st March. This is before the start of the tax year over here. And this one is on 31st March 2026 over here, which is over here. So this is falling in your tax year now. So that is why the second one over here is taxable, and the first one that you have over here, it's not taxable over here. So this is the difference basically. right? Just keep in mind, just make up the, this timeline over here, help you as well, right? Because yes, bonus does get a bit confused over here, because normally in other areas, or particularly speaking in most of the areas, the tax rules are basically according to the cash basis over here. But in the bonus, this is basically the other way around, right? In the bonus topic, basically this is a bit other way around, but as far as the other matters are concerned, mostly the tax authority, they are on to the cash basis over here, right? So yes, this thing gets confused a bit. Yeah, it does create a confusion over here. I agree with you. Okay, now the third point is, during the period 6th April to 30th November, ASME was provided with a petrol company car. Okay. And the car has a list price of 42,000 and an official CO2 emission rate of 173 grams per kilometer. ASME was not provided with any fuel over here. Okay. Now I have this company car with working one company car. So I'm gonna highlight this up over here, and the car benefit basic percentage we all know is 17% over here, and then we have 173 minus 55 by 5. So we get 173 minus 55 by 5. This is 23.6 over here, right? So we get a total, before getting the total, let's just get into 23% over here. So we get a total of 40% over here, but the limit is 37% over here, maximum that we can have over here, right? So we get the percentage up to 37% over here. So the car has a list price of 42,000 over here. So 42,000 into 37%, we get 15,540 for the whole year. And we got it for the number of months over here from April to November. So April, May, June, July, August, September, October, November, 8 months into 8 by 12, 15540 into 8 by 12, I get 10,360 over here for my car benefit over here. So I will go over here. This is 10,360. I will write 10,360 over here. After the company car, on 1st December, Esma purchased her own car for 20,000 during the period 1st December to 5th April. Esma drove of 23,000 miles. Okay. Of which 12,000 were for the business journeys, and then HHK reimbursed 5760 for the business journeys over here. So now we have the mileage allowance. So that's going to be working 2 over here. And mileage allowance, if we look, she drove a total of how many? 23,000, out of which 12,000 were for the business journeys over here, right? So 12,000 miles for business journey. So the main threshold is 10,000 miles with 45 pence. That's going to be 4,500. And then with 2,000 miles, the above percentage is 25 pence over here. So 2,000 into 25 is going to be 500 over here. Now let's have the what do we call it as? compensation received, RECEIVED. So my compensation received is 5760. It seems to be higher amount. Yes. And then we are going to less the lower. So we have taxable mileage allowance of 760 over here. So I will write my 760 over here. Right? Okay. Then ESMA contributed 4% of her annual salary, gross annual salary, into the HHK's PLC's occupational pension scheme. HHK contributed a further 2% into the pension scheme of the ESMA's behalf. So now we have occupational pension scheme over here. So we have a pension contribution. So my annual salary is 45,000. 45,000 into 4%. So 45,000 into 4% is going to be, oh, sorry, 4%, 4404. Okay, we have 18,000 okay, over here. Okay, so numbers are full of surprises, huh? So we are going to have the 1800 over here. Done? And what next? I have other information as well, which is during the year 25-26, ESMA received a dividend income of 6,000 over here. Okay, one thing which I can do, I have to write 760, I have to minus 1800, and I can have my this I can say this total employment income. I need to have the total for this line basically, right? Like this. This is the employment income. Then I will have my dividend income 6,000 over here. 6,000 over here. And then I made a charitable donation of 5,000 net under the gifted scheme. Okay, that is going to be with the brackets over here, nothing to do over here, right? So this is going to be my total income over here. So this is going to be the sum of this and this. Okay, nothing over here. Then I will less my personal allowance 12,570. 12,570. So I get a taxable income over here. So this is gonna be this and this over here, right? Okay. Now I have a bit of a less space, so I need to take them down a bit. Here we go. Now I have to calculate the tax liability, no? Yeah, income tax liability. So my tax liability, I have my basic rate over here, which is going to be 37,700 over here, plus the enhancement. I made 5,000 net over here now. And wait one thing. I have to write tax brackets will increase by gross pension. Sorry, not gross pension. This gross charitable donation. That's going to be 6,000 net. This is 5,000 net. So 5,000 into 100 by 80. So that's going to be 5,000 by 80 into 100, 6250. What's this total? Ms. Vanessa, 158, 640. This is the column total that I have over here. This is the total income with these two. So basic rate is going to be 37,700 plus 6250. So we have 37,700 plus 6250 into 20%. And this is going to be 43950 into 20% of 8790 over here. Then we have this total of 63,750 minus 43,950. So 63,750 minus 43,950, I get 19,800 over here. This is going to be taxed at 40%. So that's going to be 7,920 over here. Right? Okay. And now, as far as the dividend is income is concerned, on the first 500, I am going to have 500 into 0% is going to be 0 over here. And then this is 6,000 minus 500 with the second bracket additional. So I have 33.75%. So that's gonna be, okay, I didn't follow the format. So this is 5,500 into 33.75. We get 1,856 over here. So my income tax liability is going to be this one, 1,856 over here. Right? All right. Then moving ahead, we have explained how a married couple can reduce their income tax liabilities for the tax year 25-26 by claiming the transferable amount of personal allowance, the marriage allowance, and state why such a claim is not possible for Asma and Andy over here. Now, basically, we all know that the total amount at the end of the day, after doing all the working and everything, is basically 252 pounds, right? I mean, we get, as far as the difference is concerned, the transferable amount is basically 1,260. So we take up the 20% for that, that is 252, right? So the total threshold allowed is 252 pounds. And in order to have the transfer allowance, now, the rule is that both the spouse, they have to be into the basic tax bracket over here. And over here, it's not going to be possible over here for the Asme and Andy over here without looking at the Andy. This is not possible over here because Asme is falling into a higher tax bracket. So if you are into the higher tax bracket or something, now you cannot claim this because both the spouses, they have to be into the basic tax bracket. So this is what you have to, write over here. So if in a summary or a nutshell, I can simply say the transferable marriage allowance among the spouse under the tax law is 1252. Right? No, this is 1260. This is 1260, yeah, of the personal allowance. This personal allowance will attract a tax relief of 1260 into 20% of 252, right? In order to avail this relief, both the spouses have to be in basic tax bracket. Esme and Andy will not be able to avail this discount as Esme is falling in a higher tax bracket. Simple. No need to write any fancy or no need to write anything else over here. Okay, then we have part C over here. Explain how both Asma's income tax liability and Andy's income tax liability for the tax year would be affected if they were to transfer all of the quoted shares currently held by Asmi to Andy. Quoted shares. Okay. The dividend ones. Asmi is married to Andy. Andy's only income is a dividend income of 7,000 over here. Both Asmi and Andy's income is expected to remain the same for the foreseeable future over here. Okay. So if I go over here, part C, if Asmi were to transfer all of his quoted shares to Andy, then Asmi's total taxable income would have reduced by £6,000 and Andy's income would have increased by £6,000, right? The following tax effect would have achieved. Asmi's income, current scenario, tax paid on dividend income is 1856. Right? And his income, proposed scenario. Total income, current, that is 7,000. Add additional dividend income, 6,000. Total income, 13,000. Less personal allowance, 12,570. Taxable income, 430. Right? So tax liability is, first 500 is taxed at 0. So that's gonna be 0 over here. So it would have been, it would be beneficial for Esme and Andy to transfer the dividend income to Andy, as there will be a tax saving of 1856, right? So I have shown you the whole, like, the working over here, by which we can have a tax saving over here. Right? Okay. Now, next question, Tony. Starting in a minute. Okay. So we have this Tony over here. This scenario relates to three requirements. Up to and including the tax year 23-24, Tony was a resident in the UK for the tax purposes, spending more than 300 days in the UK each year. Tony understands that for the tax year 25-26, she will again automatically be treated as a resident in the UK, but is unsure of her resident status for the tax year 24-25 over here. For this tax year, Tony was neither automatically resident in the UK nor automatically non-resident. So throughout the tax year, Tony was traveling around the world and did not stay in any one country for longer than 30 days over here. Okay. Although she did spend a total of 50 days in the UK, Tony has a house in the UK, but it was let out throughout the year. She's single, no children, stayed with a friend for the 50 days that she spent in the UK. Tony did not do any substantive work in the UK during the tax year 24-25. So the following information is for the 25-26 over here. We have this employment, then 1, 2, 3 over here, then the property income, very good. Then the other income, and then we, okay. Just a 4 mark question. Houston, I have missed something. Let me paste up the remaining question over here and then we'll resume. Where is the over here? Oh yes, I missed the basic part of the question over here. Here we go. Now it's fine. Okay, explain why the Tony was treated as not resident in the UK for the tax year 24-25. Now, I'll go for the first part over here. And it says Tony was previously resident and was in the UK between the 46 to 90 days, technically speaking, right? So obviously speaking, yeah, she would therefore need three UK ties to be treated as a UK resident over here, right? Over here. Now she stayed over here for the 50 days now, so she needs to have the three ties over here to be treated as a UK resident. She has a house, number one, and then she stayed over there for the 50 days. That's it, right? So technically speaking, only two ties over here, right? And spending the more time in the UK over here along with that as well. So that is why this is gonna be difficult for her to be accounted for not resident in the UK for the 24-25 over here, right? Because during the 24-25, if we talk about, she did not stay in any one country over here, now. So that is why she's not gonna be treated because only two ties are met instead of the three, so she can't be a resident over here. Then list four factors which are indicators of the Tony being treated as employed in relation to her contract. Okay. Now let's just talk about this employment over here. On 6th April 2025, Tony, who is a software developer, accepted a one-year contract to maintain the websites for the Droid PLC. Droid PLC treated the contract as one of the employment, with the payments to Tony being subject to payee. However, Tony thought that because she was working from home, her employment status should instead have been one of self-employment. Okay. So the company is treating her as an employee, so is deducting the pay. But the Tony, on the other hand, is thinking that as she's working from the home, so she should be self-employed over here. So we have to list the four factors which are indicators of Tony being treated as employed in relation to her contract with the Android PLC rather than being a self-employed over here. And you should confine your answer to the information given in the question as well. Now, we'll go over here on the first point over here. For the term of the contract from 6th April to 5th April, Tony was paid a fixed gross amount of 6,200 a month. During the term of the contract, Tony was not permitted to work for any other clients. Okay. Now, this is the point number one. During the term of the contract, Tony is not allowed, is not permitted to work with any of the other client. She was required to do the work personally, not being permitted to subcontract to work anywhere else as well. So this is the second point over here as well. That the Tony is not permitted to work for any other client, and then she has to do the work personally. She cannot sublet it. Then, during the terms of the contract, Tony worked from home but had to attend weekly meetings at Droid PLC offices to receive the instructions regarding the work to be performed during the following week. Now, she's getting the instructions on a week by week basis about what to do. Then, during the period from 6th April to 5th April, Tony used her private car for the business visits to the Droid PLC clients. She drove 2,300 miles, for which the Droid PLC paid an allowance of 60 pence per mile. Okay. During the term of the contract, Tony leased the computer equipment at a cost of 180, and this is used for 100% business over here. Okay. Now, if I see the part B, I can say the contract is for a whole 1 year, not for a month, or technically speaking, the contract is financial risk to Tony being working as a self-employed, i.e., there is always a financial risk when you are working as a self-employed, but in this case, there's no risk, right? Then Tony only worked for Droid PLC, not allowed to work for anybody else during the term. Then Tony is required to do the work personally, can't outsource, and then Droid PLC exercised control over Tony to guide what to do on a weekly basis, right? So these are the points which are making Tony as an employee over here. Okay, now part C. On the basis that the Tony is treated as employed in relation to her contract with the Droid PLC, calculate her taxable income for the tax year 25-26. You should indicate by the use of the zeros for any items which are not taxable, not deductible. Okay, so I'm going to go over here with the part C. Tony, taxable income 25-26. Yeah, taxable income. Here we go. So first thing first, we have an employment income over here. Okay, so the employment income. Tony was paid a fixed amount of 6,200 a month. 6,200 a month. I get 6,200 into 12 as 74,400. Right? Then she used her own car and she's receiving 60 pence over here. So mileage allowance, working one, working one, mileage allowance. She drove 2,300 miles. Allowance received 2,300 miles into, she received 60 pence. That's 1,380 less allowance allowed. 2,300 into 45 pence. 1,035. So taxable allowance 345. Then, during the terms of the contract, Tony leased the computer equipment at a cost of 180 a month. This is for 100%. So this is going to be a business expense, approved business expense. So leasing cost 180 into 12. So we have this 2160 over here. Then we have property income. I'm going to go into the working. Here we go. It says Tony owns a freehold house which is let out. The total amount of the rent received in the year was 10,080. Total rental income 10,080 over here. Then Tony partly financed the purchase of the property with a repayment mortgage, paying a mortgage of 4,200 over here during the tax year. So basically now we have a mortgage in trust over here. Now, there's no relief for as far as the mortgage interest that you pay over here. The relief is normally given at the bottom when we do the calculation for as far as the tax and everything is concerned. So we are not going to bring in any this mortgage relief over here is concerned. So mortgage interest, we're not going to have any relief over here or something related to that. And then during May, Tony purchased a new washer dryer for the property at a cost of 640. This was a replacement for an old washing machine which was scrapped with nil proceeds. The cost of a similar washing machine would have been 380. So I'm going to have this washing machine with the same similar cost of 380 over here, not the incremental cost over here. Then during November, Tony purchased a new dishwasher for the property at a cost of 560. The property did not previously have a dishwasher. So for the dishwasher, that's gonna be 0 over here. Right? After the dishwasher, the other expenditure on the property for the tax year amounted to 1110. And this is all allowable. Other expenses allowable 1110 over here. Then during the tax year 25-26, Tony rented out one furnished room of her main residence. During the year, she received 8580 and incurred allowable expenditures of 870. Tony always uses the most favorable basis as regard the tax treatment for the furnished room. Right? So this is the furnished accommodation. Furnished accommodation. So we have a renter room relief basically. And the threshold is 7,500 for that. So this is the 8580. 8580 minus 7,500. So 8580 minus 7,500, we get 1080. So my property income 9670 over here. Right? So my property income 9670 over here. Right? After the other income, now after the property income, I have other income over here. In the other income, on 1st July, Tony inherited 100,000 nominal value of gilts paying interest at the rate of 3%. Okay. The inheritance was valued at 120,000. Interest is paid half yearly on 30th June and 31st December based on the nominal value. Okay. Tony sold the gilts on 30th November for 121,250. including the accrued interest over here. So we got on 1st July, we sold on 30th November. So July, August, September, October, November. We hold them for 5 months. Let's have the interest income for the 5 months over here. Right. So I am going to call them as saving income because this is the guilds over here. The 100,000 with 3% with 5 months. 3% into 5 by 12. I get 1250 over here. And then I received a premium price bond or yeah, price bond. That's going to be 0 over here. And then I received the interest of 520 on the maturity saving of NSI. So interest from saving certificate, that's going to be 0 as well, right? Because these are not taxable over here. So I will have my, no point is left. Total income over here, that's going to be 83505. From this, I will less my personal allowance, 12,570, and then I will have my taxable income of 70,935 over here. Right? So this is what we have over here. Okay, the next question in line is the ETHL over here. The scenario relates to two requirements over here. And the first requirement is calculate ETHL's taxable trading profits for the year ended 5th April, assuming that she prepares her accounts using the cash basis and opt to use the HMRC's flat rate expense adjustment for both the car and the private use of the business premises. Your answer should be supported with the brief notes to explain how you have treated the transitions in the notes 1 to 4, and you are going to ignore the VAT over here. Ethel Brown started to run a small bed and breakfast business as a sole trader on 6th April 2025. She prepared her first accounts for the year to 5th April 2026. She has read about the cash basis for the accounting and the HMRC's flat rate expense adjustments, which are intended to simplify the tax accounting for the small businesses. In the year to 5th April, she has the following transactions. Ethel earned income of 74,500 during the year. And then at 5th April 2026, 10,000 of the income was still outstanding. Okay. Payment of 25,000 is spread to the food, utilities, and the household costs. She lives in a part of the bed and breakfast premises with her husband and two children, and 35% of the food, utility, and other household costs relate to the private use. HMRC flat private use adjustment for 4 occupants of the business premises is 7,800. On 1st June, Ethel paid a car dealer 14,000 by check for a car with a CO2 emission of 40 grams per kilometer. She also made the payment of 3,000 relating to the running cost of the car for the year. And then she has used the car 40% for the time for the private use. And she drove 11,000 business miles during the year. On 1st March, she acquired an item of kitchen equipment for 350 on credit terms. She paid the supplier's invoice on 15th April. So we have to calculate the taxable trading profits for the year ended 5th April on the cash basis over here with a flat rate scheme. So part A, this is Ethel Brown, and we have to do the calculation of taxable trading profit with cash basis flat rate expense adjustment over here. Now, we have a revenue, earned income of 74,500, and then 10,000 of the income is still outstanding. So we are going to have the income of 64,500 over here. Less food expense. Food expense 25,000, and the personal expense for the food is 7,800 over here. Personal food expense 7,800 deducted from here. So we are going to have the food expense of 17,200 over here. All right, all right. Then I am going to have the next thing in line, paid the car dealer for 14,000 of the check over here. And then I have the less approved mileage allowance over here. As far as the approved mileage allowance is concerned, she drove 11,000 over here now. So this is gonna be, let's just have a small working over here. 10,000 with 45 pence. 1,000 with 25 pence. That's going to be 250. So allowable 4750 over here. So approved mileage allowance 4750 over here. Then she acquired an item of kitchen equipment over here. This is on credit term and it's been paid on 15th April. So kitchen equipment not paid in the year, so it's gonna be 0 over here. Right now, this also said that you have your answer should be supported with the brief notes over here. With the brief notes, if I go over here, this is going to be note 1. Note 1, I can simply say the income included here will be on cash basis. So the income still to be received of 10,000 will be deducted from here. Then we have the note 2. Food expense will only be deducted from here, which are related to business. Personal food expense will not be deducted. Right? Okay. Then note 3. This is going to be note 2. Then approved mileage allowance. Adjustment here will be done for approved mileage allowance. The cash paid to acquire the car will not be deducted from here. The capital allowances allowance on the car will not be available as Ethel is using the approved mileage allowance, right? And note 4 for the kitchen equipment. The kitchen, KITCH, kitchen equipment cost will not be deducted from here in the current year as it is not yet paid and will be allowed when actual cost is paid in the next year, right? So I will write about this over here. Done? Okay. So my taxable trading profit over here will become 42,550 over here. Done? Okay. Then the next part is calculate the Ethel's tax adjusted trading profits, assuming that she elects to prepare her accounts on the accrual basis over here. Okay, now if she use on or goes on the accrual basis over here. Okay, now I am simply going to go with the part B. This is again Ethel Brown calculation of tax adjusted trading profit on accrual basis. So we have the revenue. The revenue total was 74,500. I have less food expense. Total expense is 74. No. Payment of 25,000 and 35 is related to her personal. So remaining is 25,000 into 65%. So that's gonna be 16 to 50 over here. Then after that, we have a car running expense, car running cost. She made totaling 3,000 related to the running cost over here. So how much is related to 40% is private, so 60% is business. So this is going to be 1,800 over here. Then she got a kitchen equipment over here. On credit terms. Now, if I go over here, honestly speaking, this is something on the kitchen equipment. Basically, she will have the capital allowances over here. So I have the capital allowance and the working one. Capital allowance over here. Okay. Now, I have the main pool, private use car, And then I have my allowance over here. Okay. I have my additions over here. So I got my car with a private use as well with a 14,000. Right. Then I got my equipment for what, 350? Yeah. Less AIA minus 350. That's the direct allowance over here. Right. Then we have this WDA at 18%, 14,000 into 18% into business use. So that's gonna be 1512 over here as an allowance. All right, and over here we will have the total amount. Okay, right? So my total allowance that I need to take into account 1862 over here, right? So 1862 is my allowance. So tax adjusted trading profit 54588 over here. Done. So this is what I am going to have over here. Now, moving ahead from here, we have a next question, Anna. This scenario relates to three requirements. Hana has been trading for many years, preparing accounts to 31st March. On 1st January 2026, she commenced part-time employment with Lomley Limited. Okay. And then the following information is available in respect for the tax year 2526 over here. Okay. Self-employment. Hana's tax adjusted trading profit for the year ended 31st March 2026 was 81,770. This figure is before taking account of the capital allowances. Hana uses the accrual basis. On 1st April 2025, the tax written down value of Hana's plant and machinery were main pool 25,000, car 7,700. The car has a CO2 emission rate of 105 grams per kilometer and is used by Hana 40% for the business mileage. Then on 15th May, Hana bought office equipment for 4,500. She replaced her old car by exchanging it for a new one with a part exchange of 10,000. Hana had to pay additional 25,000 for the new car. The CO2 emission of the new car is 45 grams and the private usage remained the same. Then on 31st December, she sold some old plant, and then for the tax year, she has transition profits of 4,500. Then she has the employment, living accommodation, beneficial loan, travel expense as well. And then the requirement is calculate the trading income. Calculate the trading income assessment of Hana for the tax year 2526 over here. So we have the trading income assessment for the tax year 2526 over here. So we have the trading profit for the year. So my trading profit is 81,770. Then I have my capital allowances, for which I got to go into the workings. Capital allowance. I have the main pool, then I have the car over here. So I will have my main pool. I have the car with the private use as well. And then I will have my allowances over here. That's going to be over here, over here, over here, and over here. Tax return on value brought forward. On the main pool, 25,000. On the car, 7,700. Then, first thing first, Hana bought an office equipment for 4,500. Additions, office equipment for 4,500 less AIA 4,500. So this 4,500 is over here. Then I have addition of a new car. I read it over here. She replaced her old car and she got the new one for additional 25,000 plus the part exchange over here for 10,000. So total is going to be 35,000. So new car is going to come in over here. This is new car. This is old car. And I got the disposal of the old car for 10,000 over here. Right? Okay. And then she sold some old plant for 24,500 as well. Disposal, old car, disposal, equipment for 24,500 over here. Okay. Right? So I will have the revised balance over here. $500 over here. And then 2,300 over here. And then 35,000 over here. Right? Now I will have the small pool written down value because it's less than 1,000. So all of it is going to have an allowance over here. I will have a balancing charge of 2,300 over here. So this will be deducted from here. Then I have WDA at 18% for the new car. That is 6,300. But over here, I will have for the private use adjustment over here. And what is the car for the private used? I read about the private use somewhere. Anna uses 40% for the business over here. So 60% is the private, 40% is for the business. So I will have this into 40%, right? So I will adjust it over here in the context of the allowance over here. So this has to be 6,300 into 40% over here. So 2,520 over here, right? That is the allowance over here. And then this balancing allowance, this has to be adjusted over here as well. And I am supposed to take its 40% as well. Because in the allowance column, I have to adjust for the private use over here, right? So my total allowance carried is going to be 6,600 over here. Okay. So my capital allowance 6,600 over here. Done. Now moving ahead from here, I am going to have my tax adjusted trading profit for the year. And that's gonna be 75,170 over here, right? And then it said that I had some transition profits to HANA. So these transition profits are going to be added as it is. Transition profit, which is 4,500, right? So my trading income for the year is 79,670 over here, right? So my trading income over here is going to be 79,670. Okay. I hope it's clear. Now, part B. Calculate the employment income of HANA for the tax year 25-26 over here. Now I have to calculate the employment income over here. So this is part A. This is going to be the part B. The employment income for the year 25-26 over here. So let's start. Employment. On 1st January 2026, Anna commenced part-time employment with Lome with a limited earning a gross salary of 125,000. Normally, also provided Hana with the following benefits. So I started off on the 1st January, my year end is 5th April. So technically speaking, January, February, and March, only 3 months have gone by. So my salary 125,000 into 3 by 12. That's gonna be 31,250. Then the benefits are provided. I have the living accommodation over here. On 1st January 2026, Hana moved into a property owned by Lomle, which does not qualify as a job related. The property has an annual value of 16,000. The property was purchased by Lomle on 1st September for 250,000 and its market value on 1st January was 280,000. I have my living accommodation with working one. So I have this living accommodation. Okay, now if I go into my living accommodation now, I have to see the comparison between the annual value, 16,000, and I'm gonna see the additional charge as well, which is the property is purchased for 250,000 minus threshold 75,000 into we have 3.75%. So additional charge 250 minus 75,000 into 0.0375. That's going to be 6562.5 or rounded off to 6563. So now I have total value of property, which is 22,563. Benefit for 3 months, 22,563 into 3 by 12, 5640, or that's going to be 565, 5641, right? Okay, so living accommodations over here. Then I have the beneficial loan. I might have to go to the working too. Long Limited provided Hannah with an interest-free loan of 60,000 1st January. She has repaid 2,500 at the end of the month, each month starting 31st January. So she paid on 31st January, 31st February, 31st March. The taxable benefit in this respect of the loan is calculated using the average method over here. Now, I have the beneficial loan over here. Now, if I go into my beneficial loan, balance at 1st January 2026, I have a 60,000 over here. Then balance at year end, 60,000 minus, she was paying 2,500 a month for 3 months. So 60,000 minus 2,500 into 3. So that's going to be 52,500 over here. So the total amount is 112,500. Average loan 112,500 by 2. That's going to be 56,250. Right? Now, my taxable benefit 56,250 into standard rate of interest is 3.75% into January, February, March, 3 months. So that is 56,250 into 0.0375 into 3 by 12, 527 over here. So beneficial loan that I need to take into account, 527 over here. Then I have travel and expense over here. During the period 1st January to 5th April, Hannah used her private car to travel 6,000 business miles. She was reimbursed by Lomley at 50 pence per mile. Okay. So I have mileage allowance, working 3. So this is a mileage allowance over here. Now, as far as the mileage allowance is concerned, I can simply write mileage allowance received, RECEIVED. That is how many miles? I had 6,000 business miles. Okay. And I received what? 60 pence? 50 pence. So that's going to be 6,000 into 50 pence at 3,000. This is what I received, less approved mileage allowance. That is 6,000 miles into 45 pence. 2,700 is allowed. So taxable benefit is 300 over here. Approved mileage allowance, 300 over here. Then Anna also paid 450 out of her own bank account for the hotel rooms which she stayed during the business trips, normally reimbursed for her for these expenses. Okay, so this is going to be reimbursed expenses. That's going to be zero over here because these were for the business. So my employment income is 37,718 over here, right? Okay, now moving forward, moving ahead, explain how the tax treatment of the property provided to Hana would differ if it qualified as a job related accommodation. Okay. How the tax treatment of the property to Hana would differ. I mean, if it would have been, the job related over here, I can simply write about it as like, that if the accommodation was related to the job, then there would be no taxable benefit because if it's for the job related, then zero benefit over there, right? So, I mean, if you want me to, I can write for the part C that if the property provided by this is Lumley Limited, na? Yeah, Lumley Limited was job related accommodation, then there will be no taxable benefit. So simple, right? So this is what, and we're gonna go into the full screen. Okay, so the first question is going to be the ZHI or the Z. This scenario relates to four requirements over here. One, two, three, four, A, B, C, D over here. Okay. So all requirements are 2 marks, 3 marks, 2 marks, 3 marks over here. And the question is, you should assume that today's date is 15 December 2025. Z has been self-employed since 2007, preparing accounts to 31st December. On 1st December 2025, Z purchased a new freehold warehouse for 164,000 for use in his business, but this purchase has resulted in Z having cash flow problems. He has various tax payments becoming overdue the next 2 months and would like to reduce or postpone these payments as much as possible. Okay. Now, income tax and the national insurance contribution that he has. Z's income tax liabilities and class 4 NICs for the next year, for the tax year, sorry, 23-24 to 25-26, inclusive are forecast to be 23-24, the income tax liability is 25,200 and class 4 NIC is 4,084. Then for the 24 and 25, 24-25 and 25-26, they are 27,618,000 over here. Okay. Z has not made any claims to reduce his payments on the account over here. Okay. Then we have the capital gain tax over here. Okay, then we have the value added tax over here and the pay and the NICs over here. So this is the income tax liability and class 4 NIC over here. The first requirement is calculate the amount by which Z can claim to reduce his self-assessment income tax and NIC due for payment on 31st January 2026 without incurring the interest or the penalties over here. Okay, so the first part that we have over here related to this income tax and the NIC, we have this part over here about which we have to talk about is to calculate the amount by which we can claim to reduce the self-assessment income tax over here. Okay. Now, if we look over here, if I talk about for 31st January, so we are going to have, okay. Now, if I go over here, we have first thing that is on the 24-25 over here. Okay, and then this is 25-26 over here. Now, if I go into 25-26 now, so we have the current payment on account. This is going to be for the 24-25 over here now. That is 27,600 plus 4204. So we take up its 50%, and that is what the amount that we have over here. And that's gonna be 27,600 plus 4204 into 50%. So that's gonna be 15,902 over here. Okay. And then the revised one that we have, that is 18,000 plus 3724 into 50%. So 18,000 plus 3724 into 50% is going to be 10,008. So this is the current one which we have to pay no matter what. And this is something which we can avoid at the moment, right? So we can have 1 second. Okay, so this is the current one which we have to pay for 24-25. And then for the 25-26, we can claim for the reduction over here by the 50% over here. So the reduction which we can claim over here is going to be 5,040. So we can simply say that the reduction in liability without any penalty can be of 5,040 over here, because the last year's balancing payment for the tax year 24-25, which is due on 31st January, this is something which we cannot avoid. For the 25-26, we can avoid it for now at the moment, right? And we can, like, manage the stuff without it as well, right? So this is the part A over here. Then we go into the part B. Part B is calculate the amount by which the Z's capital gain tax liability due for payment on 31st January 2026 will be reduced if he makes a claim for the rollover relief based on the warehouse purchased on 1st December for 164,000 over here. Okay. Assume the tax rates and allowances for the tax year 25-26 apply throughout. So we have this capital gain tax over here, and Z has a capital gain tax liability of 17,520 becoming due for payment on 31st January. This is in respect of a freehold office building which was sold for 210,000 on 10th December 2024, resulting in a chargeable gain of 76,000. The building office building has had always been used for business purposes, but no claim has been made for the rollover relief over here. Okay. Now, if I talk about the rollover relief, roll relief over here with the rollover relief with the capital allowances. So we have the current capital gain tax liability, which is 17,520 over here, right? Okay. And we can have the revised capital gain tax liability over here with the proceeds not reinvested. Basically, we got the proceeds over here. We sold it for 210,000 over here, this one, and then we got the new warehouse for 164. So 210,000 minus, I got the new warehouse for 164,000 over here. So I get 46,000 over here. From this 46,000, I am going to less the annual exempt amount over here, which is 3,000. So I get this 43,000, right? So capital gain tax, which I can have over here, which I can pay at the moment is 43,000 into 20%. No, sorry. The rate for the higher taxpayer is 24%. So I will have 43,000 over here. That's going to be 10,320, which I'm going to pay for now, right? So the reduction available is going to be, rather than paying 17,000, I will be paying just 10,000 over here. So I can have a reduction of this 7,200 over here. Okay. Now I have the part C over here. The part C, if I go, it's asking that explain whether Z can reduce the amount of VAT payable on 7th February by not issuing a sales invoice for the credit sales of 45,600 until the 1st February, and if so, by how much the payment will be reduced over here. Okay. So we want to defer the sales invoice till 45,600 over here. Okay. Z has forecast that he will have to pay the VAT of 20,200 on 7th February 2026 to HMRC in respect of the VAT for the quarter ending 31st December. And then on 12th December, Z dispatched goods relating to an exceptionally large credit sale of standard rated goods of 45,600 inclusive of VAT. He has not yet issued a sales invoice for this sale because the customer is unlikely to pay until 28th February. Z is considering not issuing a sales invoice until 1st February. Okay, so explain whether Z can reduce the amount of VAT payable on 7th February by not issuing an invoice until the 1st February, and if so, by how much amount of VAT will be reduced. Now, if I talk about this point over here, normally the tax point for the goods sold is the date when the goods are transferred or made available to the customer, which in this case is 12 December 2025. December 2025 over here. Right? So the invoice date of 1st February 2026 will not affect this because the invoice is issued after 14 days, not within the time period of dispatching the goods. So the tax point will still remain at 12th December 2025, right? Therefore, Z cannot reduce the amount of VAT payable on 7th February 2026 over here. The amount cannot be reduced over here, right? Then we have part D as well. The part D is calculate the amount by which Z's pay and NIC due on 22nd January will be reduced if he delays the payment of employee bonuses until 10th January 2026 and state when the postponed amount will be payable. Your calculation should be based on annual income tax and NIC's thresholds over here. Okay. Now, if I go over here in the pay and the NICs, Z will have to pay the NIC. Z will have to pay the pay and NIC of 5526 electronically of his two employees for the tax month running from 6th December to 5th January. This includes amount for the bonuses which Z was planning to pay to his two employees on 1st January, but he could delay the payment until the 10th January. The bonuses are in respect for the year ended 31st December 2025, and they will be treated as being received on whichever is the date of payment. The first employee has a gross salary of 20,000 and is to be paid a bonus of 1,500. And then the second employee has a gross salary of 55,000 and is to be paid a bonus of 5,000 over here. So, if I go with the first employee, the pay is total pay is 5526 and the NIC is okay. Now, the first employee has a gross salary of 20,000 over here. Okay. And is to be paid a bonus of 1,500. So he will get a bonus of 1,500 over here. So the paid tax over here on the 1,500, according to the basic rate, is going to be the 20%, and that's going to be 300 over here. Okay. Now, as far as the NIC is concerned, the employee with a bonus of 1500 is gonna have the NIC of 8%. This is the 8% over here. And the employer NIC on this bonus is 15%, right? So that's going to be 225 over here. Now, with this, if you remember, I shared the tax rates with you. Let me just show you this NIC working. How am I doing it over here? Okay. Look, this is the NIC working basically. This is the class one employee over here. Right? So over here by the employee, this is 8%, right? Up to the 50,000 to 70. So technically speaking, that is just 1,500 over here, right? And then for the employer, this is at 15% over here. So that's why I got the 8% for the employee and 15% for the employer, the Z over here. Then we have the second employee over here. Now for the second employee, the pay is 5,000 bonus. This 5,000 bonus, right? So the salary over here annual is 20,000 over here. Now the annual salary is 55,000 over here. So as the salary goes to the 50,000, technically speaking, that is going to be for the 50,000 and above the class one. That's going to be the 2% over here. So 5,000 into 2% is what I have. And then for the employer, that's going to be still 5,000 into 15%, right? So that's going to be 750 over here. Okay. And no, sorry. This is the employee paying as far as the NIC is, sorry, employee paying as far as the NIC is concerned. Over here, the pay is 5,000 into 40% tax. So that's gonna be 2,000 over here, right? Now, the total that we will have over here is 3,495, right? So this is the postponed pay and NICs of 3,495 will be payable 1 month later on 22nd Feb 2026 over here. Rather than paying this now, I mean, if we can delay it by 1 month over here, right? So this is what you can achieve over here. Okay. Now, let's see question number two. That is HANA. If I talk about the HANA over here, this scenario relates to three requirements. HANA has been trading for many years, preparing accounts to 31st March. On 1st January, she commenced part-time employment with the Longley. We did happen to do this question. And this Longley, we did this question yesterday. I have copy pasted it again over here. No, we are not going to do this question. We have already done this. Okay, let's just go to the question 118 over here. I mistakenly copied the wrong question over here. Okay, anyhow, we have Ashura over here. This scenario relates to four requirements. Ashura has been employed by RIFT PLC since 1st January 2022. She has also been self-employed since 1st July 2025, preparing the accounts for the 9 months period ended 5th April 2026. The following information is available for the tax year 25-26 over here. Okay. Now, we have the employment and the self-employment over here. And then we have this other information along with the self-assessment tax return. Requirement, first requirement is basically to calculate Shura's tax adjusted trading loss for the 9 months period over here. Tax adjusted trading loss over here. Okay. Now the employment is that during the tax year, Shura was paid a gross annual salary of 56,200, from which she paid 5% into the RIFT occupational pension scheme. Then we have on 1st January 2026, Ashura personally paid two subscriptions. The first was a professional subscription fee of 320 paid to an HMRC's approved professional body. The second was for the 680 to a health club with Ashura regularly uses to meet the RIF PLC clients. Okay, Ashura was not reimbursed for the cost of either of these subscriptions. And then during the tax year, Ashura contributed 3,400 into the personal pension scheme. This is for the employment. Now, as far as for the self-employment, we have these points over here. And the first point is going to be related to this one over here. And that is to calculate the Ashura's tax adjusted trading loss for the 9 months. So, Ashura's tax adjusted trading profit based on her draft accounts for the 9 month period ended was 10,930. However, this figure is before making any adjustments required for the cost of the Ashura's office note 2 or the capital allowances note 3, and she suspects she will actually have an allowable loss for the tax purposes. Ashura has elected to use the accrual basis over here. So I have the part A, that is the Ashura trading loss for 9 months period ending 5th April 2026 over here. So we have draft profit over here. This is 10,930. Then we have these points over here. And this is Ashura runs a business from a newly built office. Construction began on 2nd November and was completed in June 2025, shortly before Ashura started trading. Okay. No deduction has been made for the 110,000, the cost of the office, in calculating the profit of 10,930. Okay, the cost was made up like this: building, heating system, water system, decoration. Well, the decoration is something which is a revenue expenditure, and we can bring it up over here, and that is 3,100 over here. Right, this will be deducted from there, whereas these expenses, building, heating system, water system, these are the ones which we can bring up over here as an into the structured allowance is concerned, right? These, because this heating and water over here, the heating system, the water system, these are something which qualify normally as an integral feature of the building rather than the part of the cost of the building over here. Now, so normally they qualify for the AIA as well, right? The capital allowances over here. And as far as the decorations they are concerned, they are normally the revenue expenditure basically over here, right? So I will go for the structured building allowance over here. So I can call it as the structure building allowance. That's going to be the working one. structured building allowance over here. So I am going to have my qualifying expenditure on the building cost over here, which is going to be 97,600 over here, right? So I will have this 97,600 over here. Okay. So this is gonna go over here, 97,600. So my SBA at 3% is going to be 97,600 into 3%. I get 2,928 over here. And I completed the building in June over here. Now I have to go till the April over here next year. So in June, so July to December 6 months, and then March 9 months. I have it over here for the 9 months over here, right? So 9 months adjustment is 2,928 into 9/12. So this becomes 2,196 over here, right? So the structured building allowance 2,196 over here. Then I have the capital allowances over here. That's gonna go into the working too. So capital allowance that we're gonna have over here is main pool. Then we are going to have two columns over here and then the allowances over here. These columns I'm leaving over here just because if we have some other adjustment to account for. Okay, that is gonna be over here. Okay, so we have total income over here. We don't have any balance over here, no? Yeah. So I am going to have the additions. I have the heating system. I have the water system over here. So heating and water system is 5,100, 4,200 over here. And then on this, I am going to have AIA at 100%. So this is going to be the sum of these two over here. So that's a 9,300. So I will have the allowance of 9,300 over here, right? These two done as well. Now, the point number three, on 10th June, Ashura purchased a laptop computer for her use in her trade for 2,600. Then Ashura purchased a car for 19,200. The car has a CO2 emission rate of 87 grams. During the 9 month period ended, Ashura drove a total of 8,000 miles, of which 2,400 for self-employed business journey over here. Okay, so we have a laptop over here for 2,600. So I am going to have in these additions a laptop for 2,200, 2,300. Again, on this, I am going to have this 2,300 AIA over here. Then I have a car with a CO2 emission. So I will have the value over here. And car is for 19,200. And this is the car with a private use as well. Right? So on this, I have the CO2 emission of 87 grams over here. Okay. So, Shura's car is basically at 87 grams. This is above 50 grams per, kilometer over here. So, therefore, it's going to qualify for the allowance of 6% over here as well, right? So, that is going to qualify for the 6% over here. So, I will have the WDA at 6% over here. And then she drove 8,000 miles, out of which the business miles were 2,400. So I can write the business miles 2,400 by 8,000 is equal 30%, right? So I will have this into 6% into 30%, right? So that's going to be 31152 over here. But this is at 6%. No, I was supposed to take up the look into 0.06 into 30% over here. Okay. No. 30% is at the end. So this into 6%, we get 1152, for which we get this 345.6 over here, right? And then my total allowance over here is going to be this 11,000 over here, right? Done. Okay, 11,946 over here. Done. Now, moving ahead from here, we have this allowance of 11,946 over here. Done. So my tax adjusted trading loss is going to be 6,312 over here, right? So my tax adjusted trading loss over here is going to be 6,312 over here. Done. Then I have this other information over here. And then the second requirement is explain why it would not be beneficial for Ashura to claim the loss relief under the provisions giving the relief to a loss incurred in the early years of trade over here. You should assume that the tax rates and allowances for tax year 25, 26 also applied in all the previous tax years as well. Now, if I talk about, this trading loss over here, the trading loss would be relieved obviously against the total income for the 22-23 to 24-25 using the income of the earliest year first over here, right? So if we see the over here 22-23, because we can go back for the 3 years now, this income is total of 10,400 over here, right? So this 10,400 is already covered by the personal allowance, so 12,570 over here, right? So over here, if we file a claim against this year, it will lose the entire loss, right? And we won't be having any tax saving or something, right? So that is why it's not beneficial for Ashura to claim the loss relief under the provision for the loss incurred in the early years of the trade over here. Because by this, our first year loss, that's going to go wasted over here. So that's why we should not apply for it over here. I mean, if you want to, I can write it over here in part B like this, that the trading loss would be relieved against the total income for the tax years from 2022 to this 2022 to 2024 25 using the income from the earliest year first FIFO basis, right? The profit in the year 22-23 is 10,400, which is already covered by the personal allowance of 12,570, which, okay, rather than writing which, the profit in the year 22-23 is 10,400, which is already covered by the personal allowance of 12,570. So claiming for the early year of losses will make this year's loss claim go wasted. So there will be no tax saving here. So it's not advisable to go with this approach over here, right? Okay. Now, the third requirement, assuming that Ashura claims loss relief against her total income over here, total income for the tax year 25-26, calculate her taxable income for this tax year. Okay, now if she go for the total income over here, then what happens? Total income means the employment income as well. So we have employment income. So we had a salary. I did happen to read about the salary over here. So gross salary is 56,200 over here. So we have the pension contribution, and the pension contribution is the occupational one over here, and 5% into the occupational pension scheme. So 56,200 into 5%, so that is 56,200 into 0.05. We get 2,810 over here. And then do we have any personal pension scheme? Okay, this is the 3,400 for the personal pension scheme over here as well. So we'll have its adjustment later on, right? So this personal pension scheme is not going to affect the calculation of the taxable income, but obviously we will have the extension of the tax bracket over here now. So the personal pension scheme is going to have a 0 over here. Then the subscriptions were being paid over here. We have a professional body subscription, which is allowed under the HMRC. I did happen to read over here, and this is 320, it's allowed. And then we had some gym subscription over here as well. The gym subscription, a health club basically, yeah, a health club subscription of 680, it will not be allowed. So health club subscription not allowed, right? So the professional body subscription is going to be allowed. The health club subscription is not going to be allowed. So we will have the total income of 53070. Now we have a loss relief, and the loss relief was, what is the loss that we have? 6312. 6312, the loss that we had, right? So our net income is going to be 46,758, on which we will have the personal allowance over here, 12,570. So my taxable income is going to be 34,188 over here. Right? Okay. Now, part D, state the period during which the HMRC will have to notify Ashura if they intend to carry out a compliance check in respect of her self-assessment tax return for the tax year 25-26, and the likely reason why such a check would be made. Now, if I am filing for the tax return 25-26 over here, and if compliance check is to be carried out by the tax authority, normally they will do it this is the 1 year or 12 months time period, right? Yeah. After which the tax return have been filed now, so they have the 12 months period basically time after which normally they do, right? So over here, if I talk about, I am going to file self-assessment tax return. Ashura filed her self-assessment tax return for the year on 14th August. She is quite confident that all of her income for the tax year 25-26 was correctly declared and that no deductions were incorrectly claimed over here. Right? So I'm gonna go with the part D, that if the HMRC wants to check the compliance status, they will do so after exactly 1 year or 12 months of 12 months from the date when the file has been submitted. That is, i.e., it's 14th August now, so we will have 14th August 2027 over here, right? So if Ashura is confident that she has returned the file properly and correctly, then the reason for this compliance check is that her return has been selected on a random basis over here, right? So the return that she has filed, this is on a random basis over here, right? Okay. Now we have this Samantha question. We are starting in 2 minutes. And this is the Samantha fabric over here. The scenario relates to two requirements. Samantha Fabric has been a self-employed manufacturer of clothing since 2013. She has the following income and chargeable gains for the tax year 24-25 to 25-26 and 26-27 over here. Trading profit, building society interest, chargeable gains. Requirement. State the factors that will influence an individual choice of loss relief claim. Okay, so now if you want to go for the individual's choice of the loss relief claim, basically we look for the factors where a taxpayer can decide about onto multiple accounts when deciding what to do with the loss and how to approach towards claiming the loss is concerned so that the maximum benefit can be taken over here, right? So the factors influencing, I write part A over here because in the part B, I have this pre-formatted response. So that is why I've created it over here. So I'll write the part A over here. The rate of income tax or capital gain tax at which the relief is available or will be obtained with the preference being given to income charged at higher rate of tax. Similarly, the timing of relief available with the claim against the total income or the chargeable gains of current tax year or preceding tax year, resulting in earlier relief, then the claim against the future trading profits, right? And then the extent to which personal allowance, the capital gain, annual exempt amount, and the savings and nil rate band, nil rate dividend band may be wasted. So obviously you keep an eye on these as well, right? Now, part B, calculate Samantha's taxable income and taxable gains for each of the tax year, 24 to 27, inclusive, on the assumption that she relieves the trading loss of 81,900 for the tax year 25-26 on the most favorable basis over here. Explain your reasoning behind relieving the loss on the most favorable basis. You should assume that the tax allowances for the tax year 25-26 apply throughout, and you should use a pre-formatted response area provided to structure your answer over here. So this one is the pre-response structure over here. What's this 45? Where does this come from? What's this? I don't know. Okay. So, if I go over here, this is the trading income, this is the interest over here, right? So, technically speaking, I will have the total over here. And the total is going to be the sum of these two. And then I will have this amount over here. Then I will have less loss relief over here. And if I talk about my loss relief over here, this is 81,900 over here now. So what I can do over here, I have a loss relief of 81,900. So against the trading income, right? Against the trading, if I go, I have a total income of 21,600. So I will minus this 21,600. And then this is 52,000. So I can claim for the 50,000 over here, right? Let's just claim it against other income over here, right? So that is going to be 50,000 over here as well, right? So I will be left with the sum of these over here, 2,100 over here, and then I have this 13,500, and then this 3,800 over here, and then I will less my personal allowance over here. That's going to be only 2,100 only here, only 3,800 over here, and only 12,570 over here. After which I will have my taxable income 0, 0, and 930 over here, right? Then, as far as for the chargeable gains are concerned, I have a loss of 9,700 over here. Okay, now I'm gonna go over here with 53,600 less trading loss relief over here. And if I go into my trading loss relief, now look, I had a total amount of 81,900 over here. I had 81,900 over here, right? So out of this 81,900, I have in the current year, if I come over here, let's do the calculation over here. I had 81,900. I charged this over here. I charged this over here. So 10,300 is 10,300 is left now. So I will minus my 10,300 from here, right? I will minus this 10,300 from here. And then when I do, I have my revised balance over here. That's going to be 43,300. And then these amounts over here, less annual exempt amount. Now this year, this is 3,000. This will go wasted over here. And this is 3,000 over here, right? So I will have, okay, now I will have the revised balances. This one over here, this one over here. And then less capital loss brought forward. I have 9,700 over here, the chargeable gain. So I can simply go and I can minus my 9,500 from here. So my taxable gains, they are going to be 40,300 over here, and this one is 0 over here, right? So that is how we are gonna go over here. So basically, at first, I charge against the current income that I had over here, right? Then I charge against the other income over here. And then obviously I had the remaining amounts over here against which I charged the personal allowances over here. Then I went into the taxable gains, right? I charged against the balancing amount over here, the 10,300 over here. And then I had the annual exempt amount over here. So I charged these over here. And then the capital loss brought forward, the 9,700 was remaining, so I just minus this remaining amount from here as well, right? So that is how we are going to do it as well. Then we have next thing in line, and that is going to be another question, Michael and Sean over here. Okay. Now, if I go, this scenario relates to three requirements. The UK government uses the tax policies to encourage certain type of activity. Briefly explain how the UK government tax policies encourage individuals to save, individuals to support the charities, and entrepreneurs to build their own businesses and to invest in plant and machinery. Okay. So we have this part A, and it's asking the individuals to save over here. Now, saving is encouraged by offering tax incentives to the individuals, such as tax free individual saving accounts, that is the ISAs, and relief on pension contribution as well, right? So we have also seen the nil rate for saving income, nil rate band, right? And this encourage the basic and higher tax rate payers to save by providing the tax-free saving income over here. Then the second one is to individual to support charities as well. Now, the charitable support is encouraged by giving individuals the relief on the donations made via the gifted scheme and the payroll deduction scheme as well, where a 20% relief is given on the spot, and then the tax brackets are increased by the gross amount as well, giving the opportunity to have a higher amount of income to be taxed at lower rate. Then we have entrepreneurs to build on business. Now, the entrepreneurs are encouraged to build their own business through various capital gain tax relief such as business asset disposal relief. Investment in plant and machinery is supported through the capital allowance or allowances available under accrual basis or the deductions from trading profits under cash basis as well. Right? So we are going to have this overall speaking. Now we have a scenario B over here. This scenario relates to one requirement. You are a trainee chartered accountant and your manager has asked for your help regarding the two taxpayers who have both made the trading losses over here. Okay, one is a Michael, one is a Sean over here. As far as Michael is concerned, Michael started in self-employment on 1st July 2024, preparing accounts to 5th April. His result for the first two periods of trading were as follows. 9 months period, we had a trading loss of 24,600. Then for the year ended 5th April 2026, he had a trading profit of 7,100 only. For the tax year 2020 to 21 to 22 to 23, we had the following employment incomes as well. Michael did not have any income during the period from 6th April 23 to 30th June 2024 as well. So we have the Sean over here as well. For each of the two taxpayers, Michael and Sean identify the loss relief claims that are available to them and explain which of the available claims would be the most beneficial. You should clearly state the amount of any reliefs claimed and the rate of income tax saved over here. However, you are not expected to calculate any income tax liabilities over here. Okay. And then you should assume that the tax rate allowances are going to be the same for the tax year 25-26 applying throughout overall speaking. Okay. Now, if I go for the Michael first, let's write the Michael. Okay. We can have, this is the employment income over here now, and this is the 9 months period, the opening time period, and then this is for the next year. So we can have the special opening year loss relief over here. And we have the loss of 24,600. The opening or the loss of 24,600 can be claimed against the total income for the three preceding tax years. Earliest first, that is on a FIFO basis, since it is incurred in the first 4 years of trading. And the amount of loss claim will be, therefore, we have in 2021 44,500 over here. Then in 21, 22, we have 17,200. Then 22, 23, we have this 51,000 over here. We don't have any income in the June. Okay. So basically, we can have a loss claim. This is first year, second year, third year. We can't have for the 2020, 21 over here. Okay. So we have 2021 to 22, 2022 to 23. I have my employment income over here, 17,251,000 less loss relief. So this is going to be 17,200 over here. And this is going to be the remaining amount over here, which is 24,600 minus 17,200. So I get 7,400 over here. This is going to be 0, and this is going to be 43,600 over here. Okay, so we have this over here, we have this over here. Now, as far as the tax saving is concerned, for the tax year 2021, 2022, personal allowance will go wasted over here and no tax will be paid. Right? And in 2022-23, a tax saving of 7,400 over here into 20%. This is 1480 over here. Right? So if I go over here, this is 17,200 over here. Yeah, but we can have, okay, wait. We can also have, we will also have this saving over here, na? Saving in 2021, 2022 will be 17,200 into 20%. 17,200 into 20%. This is going to be the 3,440 over here. But this is the employment income. We will have the saving over here as well. But again, this will be like this. So we will have the tax saving over here in 21, 22. If we go, this will be this is 17,200 now. Let's minus the tax from here. This is of 12,570, right? So the amount that we are going to have, this is going to be 17,200 minus 12,570. We get 4,630. On this 4,630, we have this 20% of 926 over here. Yes, this will be saved. $926 will be 20%, and that is 926 will be saved. For the tax year 2022-23, right? Michael will have the following tax saving. Look, without the loss claim, the tax payable will be, we have this 51,000 income less personal allowance 12,570. Taxable income is 38,430 over here. So we have the basic of 37,700 into 20%, and then we have 38,430 minus 37,700 into 40%. So that is 292 over here, right? This is what I'm going to have over here, no? Yeah, because I have the employment income over here. Yes. So if I go, this is the total taxable income that I get over here, right? So now, if the claim is made, then the total tax payable will be income 51,000 less loss 7,400 less personal allowance 12,570. I get my taxable income of 3130 over here, on which the basic 31,030 into 20%, that's going to be 6,206 over here, right? Okay, so total saving will be, look, what's the total over here? 7832 minus 6,206 is 7832 minus 6,206 of 1626 over here, right? So we are going to have a net saving of 1626 over here as well. Done? Okay. And then this is where I can claim. Okay. Now, if I try to, like, this is for the first one over here, right? So 926 is saved over here, 1626 saved over here. So total saving via opting for this option will be 926 plus 1626. That's 2552 over here, right? Now, if I opt for the carry forward loss option, alternatively, Michael can carry forward this loss against the future trading profits, right? But the trading profit for the next year is only 7,100. Yeah, right over here. 7,100, which is less than the personal allowance as well. Therefore, if Michael adjusts the loss here, the capital allowance will also go wasted, right? So the most beneficial scheme for Michael is to claim the special opening year loss relief, right? So for the Michael, the best thing to do is to go for the opening year loss relief over here. Done? Okay. Now, let's talk about Sean over here. Sean has been in self-employment since 2014, but ceased trading on 31st March 2026. He has always prepared the accounts of 31st March, so his result for the final 5 years of the trading are as follows. Okay, in the very last year, he had a loss of 26,700. For each of the tax year 21 to 22 to 25 to 26 inclusion, Saul has a property business profit of 12,570 over here. Okay. So for each of the taxpayer over here, now Sean is gonna go for the terminal loss relief option over here because he's winding up his business now. So the whole loss can be claimed as a terminal loss relief since it is for the final 12 months of the business. The claim is against the trading income for the year of the loss and the 3 preceding years, right? With the latest year first. So we have the amount of loss claim over here. We can say the terminal loss claimed will be as follows. We have the loss in 22 in the year to 31st March 2026 over here. Okay, so we can have this is going to be 2023 to 24, 2024 to 25, 2025 to 26 over here, right? Yeah, this is what I have now. Now, I had my trading profits. So 2023 is over here, 14,400. For the year to 31st March 2024 is what I'm going to have over here, 18,900. These are my trading profits So year ended 31st March 24 is 18,900. Then I have 3,700 over here. And then I have a loss of 26,700. Okay. So I can claim, okay, this is the trading profit. And then I had shown property business profits. These are 12,570 over here. Sorry. 12,570, 12,570, 12,570 in the current year as well. Now, over here, I have the loss claim of 18,900 from this side, right? And then I can have how much is going to be left over here? I have a total amount of 26,700. I have claimed 18,900 over here, right? And then I have this 3,700 over here as well. So I'm left with the 4,100 over here, right? So 18,900 is gonna go in 23, 24 over here. And then I will have this 4,100 over here. But this is supposed, I have this one over here as well. So 3,700 from here. I will have the 37. No, wait. For the 22 to 23, 24, I have this 18,900 loss claim over here. And then the remaining amount is going to be, I have a loss of 26,700 over here, out of which 18,900 is claimed in 23, 24, right? And then from this 31st March 2025, I am going to claim my 3,700 over here. So this is going to be 3,700 over here. And then the remaining portion is going to be, this is 26,700 minus 18,900 minus 3,700, 4,100. So paste it here. I have this year ended 31st March 25. So I have 2024 to 25 over here, right? So I have this 3,700 over here, right? This is the trading profit for 3,700 over here. So I am going to minus this 3,700 from here, right? And then I have this 2022-23. I have 14,400 over here. And over here, I will minus this 4,100. Right? So I will minus this 4,100 over here. All right? So 4,100 remaining amount is going to be charged over here. Done? Now, as far as the tax saving is concerned, the property business profits are sufficient to utilize the personal allowances because they are 12,570 overall speaking now, right? For each year. So the loss relief claims will save the income tax at the basic rate of 20%, right? Then if I go for the standard loss relief against total income, then alternatively, Sean could have initially claimed loss relief against the total income for the previous 2 years, right? But via this approach, the personal allowance will go wasted for either both of the years. So this option will not be beneficial. Most beneficial claim will be to claim the terminal loss relief, right? So that's going to be the most beneficial way over here. This scenario relates to four requirements. We have the taxable income over here, living accommodation, partnership loss. Then we have the gifted donation, pay, child benefit, Amanda's husband as well. And then the first requirement is calculate Amanda's taxable benefit for the tax year 25-26 in respect of a living accommodation provided by her employer. So this is the living accommodation. So I'm going to go over here. Okay, I will paste it up. Let's do the part A right parallel. So part A is Amanda's taxable benefit on living accommodation over here. Okay, so we have annual value. Now let's start reading it. From the period to 1st April 25 to 5th April 26, Amanda's employer provided her with the living accommodation. Her employer had purchased a property on 10th February 23. Okay, for 174,000 and it was valued at 192,000 on 6th April and 194,000 on 1st November. Improvements costing 8,000 were made to the property during the May 2024. Annual value of the property is 6,300. The property was furnished by Amanda's employer during the August 2025 at a cost of 12,400, and the taxable benefit in respect of the living accommodation is included in the employment figure of 68,200 over here. So we have the annual value that is at 6,300. In this, we will have the additional benefit, and then the employer basically purchased the property over here on the 10th of February over here. So technically this is less than the 6 years now. So this is something which we are going to have. The additional benefit is going to be based on the property cost plus the subsequent improvements as well. So we will have the cost on 10th Feb when the property is being bought, and this is for 174,000. Right? And then we have the improvements over here, and improvement costing 8,000 were made over here, right? So we have the total over here of 182,000, right? The limit is 75,000. So we are going to have a total balance of 107,000. So the additional benefit 107,000 with the standard interest rate that is 3.75. That's going to be 4013 over here. Then we have the furniture over here as well, and that is at 12,400. So this 12,400 with a 20% over here on an annual basis. So this is going to be 12,400 into 20% is going to be 2480. So I will have the total benefit of 12,793 over here. Right now, we got the property from 1st November to 5th April. How many months? November, December, January, February, March. 5 months over here. Right? So 5 months benefits is 12,793 into 5 by 12. 12,793 into 5 by 12 is 5330 over here, right? So this is what we are going to have as a part A. Part B, calculate Amanda's partnership loss relief claim for the tax year. We have the partnership loss over here, so I am going to go for the part B, that is Amanda's share of partnership loss. And this is the part A. Now, Amanda has been in a partnership with Benny and Cotton since 1st April 2011. For the year ended 31st March 2026, the partnership made a tax-adjusted trading loss of 10,800. Okay, so the total loss for the year is 10,800. Until 31st May, profits and losses were shared equally. Since 1st June, the profits and losses have been shared 15% to Amanda, 16% to Benny, and 25% to Cotton. Amanda has claimed her share of the partnership loss against her total income for the tax year, and this is included in the deduction for the loss relief and interest payment figure of 3,200 over here. So we just have to calculate this loss over here. So we have it until 31st May. Na? So from 1st April to 31st May, total amount 10,800 into 50% is her share over here. Her share. Amanda has been in the partnership with Benny and Cotton. Okay, over here. So 33.33% is the share. So this is gonna be 1 by 3 into April and May. 2 months, 2 by 12. So we have 10,800 into 1 by 3 into 2 by 12, 600 over here. Then from 1st June till 31st March, amount is 10,800 into, now 15% is the Amanda's share, into 10 by 12. So that's going to be 10,800 into 15% into 10 by 12, that is 1350. So her total relief is 1950 over here. Part B. Part C is going to be over here. Part C is calculate the income tax and child benefit income tax charge payable by or repayable to Amanda for the tax year 25 tax 2526 over here. So we have to calculate the income tax over here. So let's see. We have Amanda's income tax payable or claimable over here. So we have the taxable income. If I go, the taxable income is 54,430. All right. And okay, everything is accounted for. I just have to calculate the tax. So the basic rate, this is gonna be 37,700 into 20%. So 37,700 into 20%, that's gonna be 7,540. I have the gifted donation. 640 is the net amount over here. So 640 by 80 into 100 is 800. I'm gonna have this 800 over here as well. So 800 into 20% is gonna be over here. Then I have the additional, so that is 54,430 minus 37,700 minus 800 into 40%. 54,430 minus 37,700 minus 800 with 40% is going to be 6,372 over here. Right? Okay. So my total income tax liability is going to be these three figures, 14,072. Then I have this pay over here. So Amanda's employer deducted 1,200 over here, right? For each of the 12 months, employer has deducted the 1,200 over here. So we have the pay 1,200 into 12 months. Oh, okay. That is why the question was saying, payable or repayable. 14,400 is what we have over here. So we have income tax repayable over here, sir. And that is of 328 over here. Right? So that's gonna be income tax repayable of 328 over here. Just hold on for a second, please. Okay, so we have this income tax repayable of negative 328 over here. Then the question asks to also ask for the child benefit income tax charge over here. Now, as far as the child benefit is concerned, this child benefit income tax charge. This is going to be, I have the child benefit received. So what's a child benefit during the year? Amanda received a child benefit of 3,149 over here. So 3,149 is the benefit received, right? Now, the Net income that the Amanda has. What is the net income? 67,000. Okay. From this, I am going to less the gift aid schemes amount. That is the gross amount of the 800 over here, right? So my adjusted net income is 66,200 over here, right? Less the lower limit 60,000, right? So I have a difference of 6,200 over here. So we have this 1% per 200 pounds of 6,200 is the adjustment required. So 6,200 by 200 into 1% is going to be this 31% over here, right? So the child benefit tax charge, I got an amount of 3149 into 31%. 3149 into 31% is going to be 976 over here. So child benefit income tax charge is going to be 976 over here. Okay, now part D, calculate the overall income tax saving and reduction in child benefit income tax charge for the year 25-26 if property income of 2,000 had been received by Amanda's husband rather than the Amanda over here. Okay. So if Amanda's husband would have gotten, so this is overall saving we need to talk about. Basically, Amanda's tax saving would have been the income tax saving, and we have the property income of 2,000 over here into 40%, that's 800 over here. The reduction in child benefit, so that is going to be 2,000 by 200, right? So this is the income over here, na? So we are going to have this percentage over here. So let's just calculate this one first. 1% per 200 pounds of 2,000. So that is 2,000 by 200 into 1 is going to be 10% over here. So that is 2,000 into 10% is going to be, sorry, this is going to be not the 2,000 over here. We have the saving over here. The child benefit is 3,149 over here. Yeah. So this is going to be 3,149 into 10% of 315 over here, right? And we have the husbands, right? So overall saving 715 over here. So 715 would have been overall saving over here. Done? A relatively straightforward question full of workings over here.